The first strategy is putting 20% down on your home just to avoid PMI. We've actually done an episode on this in the past, and we'll put a link to that episode in the show notes. But PMI stands for private mortgage insurance, and it's insurance that your lender puts on your home loan to protect them in the event that you default on that property. And it's something that people kind of see as like the big boogeyman that you have to avoid. And the way that you typically avoid it is you would put at least 20% down on your new home loan. So, for example, if you have a home that's $100,000, you would need to put at least 80% down. That would be $80,000. And if not, you would have this little amount, little in some cases, larger in other cases, tacked onto your home payment, where instead of saying, hey, I'm paying $1,000 a month, maybe you're paying $1,100 a month. And that extra $100 provides some protection to your lender, but it does not do anything for your finances. So people see it like you're throwing money away. And I can definitely understand that perspective. But while I can understand that perspective, it is not a rule of thumb that I think should be followed in all circumstances. And the reason for it is I think that there's a radical misunderstanding of not just what PMI will actually cost you, but also the available alternatives. So first, let's talk about what it will cost you. If you're looking on screen, we're looking at an article from NerdWallet that actually has a calculator for average private mortgage insurance premiums based on different credit scores. And this is one of the misconceptions about cost. The amount that you pay for PMI is dictated by the credit score that you bring to the table. So if you have a better credit score on the same home loan, you'll pay less in PMI than someone who went and bought that property and had a lower credit score. As an example, let's say that we have someone who has a $400,000 home loan, but they have low credit. Their credit score is between 620 and 639. Well, you can see on this page that the average annual premium for someone in that credit score is 1.5% of the loan amount, which in this case is $400,000. That means that somebody who falls in this range would have a monthly payment of $500 a month in private mortgage insurance. And that is significant, especially because the higher income you earn, it's not like you can take a tax deduction for that PMI. So it really can be seen as $500 a month that's being flushed down the drain. However, let's take that same home loan of $400,000 and let's assume that this person has stellar credit. They have a credit score of 760 or above. And that means that instead of paying 1.5% in PMI cost, they're paying 0.46% based on the value of the loan. Well, instead of $500 a month, that knocks their payment down to $153.33 based on these averages. Now, to be clear, is $153 a month that you're not financially benefiting from something that you should just pursue? No, of course, it's not something that you would want. But now we start to talk about the available alternatives. Now, if their mortgage is $400,000 and they had a 10% down payment, that would mean that their actual home purchase was about $445,000. That's how the math works out. So at $445,000, they chose to make a down payment that got them down to that $400,000 mortgage. And they have PMI and they put 10% down to do so, which was about $40,000. Now, because it's not 20%, that means that they have to pay $153 a month in PMI until they reach that threshold. However, the alternative would have been to put 20% down on that property. And that additional amount to meet that threshold and avoid PMI would mean another $45,000 that they had to put as that down payment. Now, to be clear, if you have money just in droves and $45,000 isn't a big deal to you, then that may be worth doing. But if you have excellent credit and you are trying to figure out, should I give them $45,000 or should I pay $150 a month? I would say that you should at least consider keeping that $45,000 and either having it for a reserve and a rainy day fund, or even putting a portion of it in the market so that you have the opportunity to earn an interest rate far and above what it could be costing you on that mortgage. Now, there are no guarantees in that scenario, but the point is just choosing to give someone an extra $45,000 is a bigger decision than people give it credit for. And if you have strong credit and you're doing it to avoid $150 a month, it's something that you should think through a little more thoroughly, in my opinion. I would also add, and this is something that we are definitely going to talk about in the webinar, not all loans require you to put 20% down in order to avoid PMI. If you have a high income, it often makes you eligible for special loan products not eligible to others. And it is very reasonable to find a product that allows you to do a 10% down payment with no PMI. And even if you did find yourself in a position where there was no special loan product and you did have the 20% down, but you chose to put the 10% because you're listening to Brenton, and 5 years into the process, you find out, you know what, I'm going to be here for a very long period of time. I really wish I didn't have this PMI on this home loan. I don't like the strategy that Brenton told me. You could also have the opportunity of what's called recasting your loan. Not to make this whole episode a teaser, but we'll talk about recasting your loan on the webinar as well. But the premise of it is this: if you have a loan that's $400,000, and it's a 30-year home loan, they're going to do an amortization, basically a calculation of what's needed to make a payment every month for those 360 months. And at the end of that process, owe $0. Now, let's say that 2, 3 years into the process, you decide to make a large lump sum payment towards your mortgage. Well, now, if you look at that amortization table, you owe less than what they were expecting you to owe at that point in time. So you can ask them to recast your mortgage, meaning that they would recalculate what's needed on a monthly basis in order to have your loan balance be at zero at the end of the 30 years. So if you do feel differently and you do 5 or 6 years into the property know that you're going to be there long term, you could make the down payment then, ask them to recast the mortgage and still get the savings that you were considering at the beginning of the process.